Hello, everyone. Let's start our today's discussion. So, today we will be moving towards one more past paper, which is ATX Practice Exam 2 on the CBE practice platform of ACCA. It is the past exam paper of December 2018. Let's look at it. You know that we are going through series of past paper sessions in which we are doing complete past papers on the exam software. We have already discussed the past papers topic wise while we were studying the course. We are doing the past papers again on the exam software so that you people can have a better idea that how you have to deal with all the topics together, how you have to deal with the exam pressure, how you have to deal with the software and other problems which you may face during the exam. You all know my approach that I develop the complete answers with you people. As I say always, it is very easy for me to just do like other teachers and just go through the examiner answer. But that will never help you develop the approach. So I solve the paper with you people like a student, and we think like a student and we draft the answers. So let's start this new paper. I want you all to concentrate and listen to me very, very carefully. Okay, now you should assume that today's date is 7th December 2022. You are a manager, has had a meeting with vendor, a client of your firm. Extracts from the memorandum prepared by your manager following the meeting, together with an email detailing the work he requires you to do, are set out below. The following exhibits available on the left-hand side of the screen provide information relevant to the question. Number one, extract from a memorandum prepared by your manager and an extract from an email from your manager. So obviously people know that this information is not very much useful. It is just basic introduction. Let's read the extract from the manager's memorandum, which will give us more detailed information about the question. I want you all to concentrate and listen to me very carefully. Background. Vendor intends to start a new business, KS, selling children clothes. The business will be partly financed by an inheritance which Venda will receive following the death of her mother. Venda's husband, Roth, will be involved in the business. Venda has not been employed since 31st December 2016 and has not received any taxable income since that date. Roth is employed and earns a gross salary of 95,000 per year. This salary is his only source of income. Venda and Roth have not made any chargeable disposals for the purpose of capital gains tax and will not make any in the tax year 23-24. So we are given with some basic information that Venda and Roth are husband and wife. Venda has not been employed since 2016. She's planning to start a new business, KS. Okay. His husband, Roth, is employed. He earns 95,000 per year. So this is some information. You all know that the first time reading of the question is not usually very much helpful. We just identify the data. Once we read the question, we identify the data, then we read the requirements and we come back to each of the heading. Now, Venda's inheritances and gifts from parents. On 1st February 17, Venda's father, Pavel, died. He left 160,000 to Venda and the residue of his estate to his wife, Lucy, who is the Venda's mother. The residue of the Pavel's estate was valued at 720,000 and included the family home. Pavel had not made any gifts during his life. On 1st April 17, Lucy gave Vanda 180,000 pounds in cash. This was the only lifetime gift Lucy made. On 1st November 2022, Lucy died. Vendor inherited the whole of the Lucy's estate, which was valued at 950,000. The estate consisted of the family home valued at 440,000, together with furniture, cash, and quoted shares valued in total at 510,000. So Venda has got certain inheritance from her mother, Lucy. So we are given some detail about the Lucy's gifts to Vanda, and we are also given detail about Lucy's husband, Pavel. Now, you all must remember, I always teach you while teaching inheritance tax, that whenever the question talks about the spouse death, see, the Lucy is gifting to Venda. Why the question is talking about Pavel? It is a hint of the topic called transfer of nil rate bank. I hope you all remember, I always say this, that whenever the examination question talks about the spouse death, always think about the transfer of NRB issue. See, our question was Venda's inheritance. We have to talk about the Venda's inheritance. Okay. Now, she was about to start the business, will be partly financed by inheritance which Venda will receive following the recent death of her mother. So the recent death of the mother, Lucy, was in 2022. But the question also gave us some data about February 2017, which includes data about the Lucy's husband, Pavel's death. Now, whenever the question gives you data about the spouse death, you have to always think about the transfer of NRB issue. Okay, then we have detail about the Venda's new business, KS. Now, if we try and look the email, and we can check that if there is an isolated requirement about inheritance tax, and we can solve it. Because then there is some new information about the business. Please prepare the following notes and calculation for use in the meeting with Venda. Part A, Venda's post-tax inheritance from Lucy. Calculate the amount which Venda will inherit from Lucy after any inheritance tax has been paid. Now, this is something isolated of the entire question. And if you read the requirement, prepare notes for use in meeting with Venda as requested in email from your manager. The following marks are available. Venda's post-tax inheritance from Lucy, it is of isolated 6 marks. So we can just solve it without reading the entire rest of the question. Now, there are professional marks available in this question. So when there are professional marks, you have to make the format also. So let's look at it. I want you all to concentrate and listen to me very carefully. Question number 1, Venda. Okay. We are making meeting notes. You can see in the requirement, prepare notes for the use in the meeting as requested by Venda. Okay. We are preparing meeting notes. Okay. Now, client name is Venda. Date, what is the date? The date was given on the first screen, if you remember. Today's date is 7th December 2022. The date is 7th December 2022 from tax manager. Okay. Subject, Venda tax planning issues. Okay. And this is the first requirement. I will repeat it again. I want you all to concentrate and listen to me very carefully. When we are doing this question number 1, you always have to make the format. You just need to read that what he is asking. Sometimes he asks about the briefing notes. Sometimes he asks about the briefing notes. Sometimes he can ask about like meeting notes, whatever he is asking. Okay. So meeting notes, client name is Venda. Date 7th December. We picked it up from the question from the text manager, and the subject is Venda tax planning issues. Okay. So now Venda's post-tax inheritance from Lucy. Now this is a separate requirement of how many marks? 6 marks. Okay. Now we can solve it from just this portion. No need to read the entire question. It can be solved from here. Okay. It can be solved from this data. Now, on 1st November 2022, Lucy died. Venda inherited the whole of the Lucy's estate, which was valued at 950,000. Now we have to calculate the post-tax inheritance. So what I will make is I will make a simple format: inheritance received by Venda from Lucy. What is the amount? It's Lucy estate, which was valued at 950,000. Okay. So this is the inheritance which is received. Given in email, in manager's memorandum. Okay, given in manager's memorandum. Okay. Now we need to calculate inheritance tax. Now that will be the main working which we have to do. So this will give us post-tax inheritance. Okay, which will be the answer we will be working out. Just give me a minute. Now. Okay, so this is the final answer which will look like. So let's do the working and we'll calculate the inheritance tax on the Venda's inheritance. Just listen to me. Have some patience. Believe me, you will be able to understand. Working. Now, Venda's mother, Lucy, died in, now what was the date? She died on 1st November 22. Died on 1st November 2022, which will be fiscal year of 22/23. Okay, now, so let's calculate the inheritance tax. I want you all to concentrate and listen to me very carefully so that if there is any query, it gets cleared. Now, death estate. What was the amount of death estate? It was 950,000, if I'm not wrong. On 1st November 22, Lucy died. Venda inherited the whole of the estate, which was valued at 950,000. Now, this is the death state. We will pick death year nil rate band. What is the death year nil rate band? Now, death year nil rate band will be fiscal year of 2022/23. Just listen to me carefully, and then if you have any query, you people can ask me. You know that I do a lot of repetition. Now we will deduct last 7-year chargeable transfers from it to get the value of the available NRV. Now, if you look at the question, the question gave us some detail about when Lucy's husband. Now see, Lucy is the Venda's mother. On 1st February 17, Venda's father. Now see, Venda's mother is Lucy and Venda's father is Pavel. So they must be husband and wife. Okay. So here it is also given the residue of the estate to his wife, Lucy, who is the vendor's mother. Pavel died, he left 160,000 to vendor and the residue of his estate to his wife, Lucy. Now, there is a hint of transfer of nil rate band topic. Now, you must be thinking that where is that? So whenever the question talks about the death of spouse, you always have to think about transfer of nil rate band issue. Okay, now, so before deducting last 7 years chargeable transfers, what I will do is that I will add nil rate band transferred from Pavel. Okay, now what is the nil rate band transferred from Pavel? Listen to me. Pavel died in February 2017, if I'm not wrong. Yes, he died in February 2017. He left 160,000 to vendor, which must be chargeable, and the rest of the estate to his wife, Lucy. Listen to me with patience. Believe me, things will get clear. Pavel died in February 2017. His chargeable debt estate was 160,000. His chargeable debt estate was 160,000 as he gave rest of the debt estate to his wife, Lucy. Okay. Pavel had unused debt year NRB. He had unused debt year NRB. Okay. Because if you read the question, Pavel had not made any gifts during his life. Pavel had unused debt year NRB because he had no other gifts. Now let's make a table. Pavel's debt year NRB. Now, if you go and look at the text tables given, the text tables are given below here. Okay, you go and open the text tables, you can find the nil rate bands. Now, if you go down in the inheritance tax head, now the nil rate band is 325,000. Now, earlier what used to be that the examiner used to give us all the nil rate bands of the previous years, which used to differ. But now in the recent exam, the examiner just gives one NRB. So we will just use 325,000. We don't need to think that there must be different NRB in the previous years. I'll repeat it again. If the examiner gives you nil rate band of the previous years specifically, you will use that amount. But since the examiner has not given us any amount for the previous year's NRB, we will just pick 325,000 as it is. So Pavel's debt year NRB is 325,000. NRB used is 160,000, which she gave to vendor, the gift he made to vendor. So his unused NRB will be 325 minus 160. Okay. 325 minus 160. So it's 165,000. I will repeat the things again. So if there is any query, don't worry, just listen. Okay. So NRB transferred from Pavel, it's 165,000. Total debt year NRB. So 325,000 plus 165,000. So the total debt year NRB is 490,000. Let me repeat it again so that if someone has any query, that gets cleared. See, what we have to calculate is we have to calculate the vendor's post-tax inheritance from Lucy. Lucy is the vendor's mother who has recently died. So the inheritance received by vendor from Lucy is 950,000. We will deduct the inheritance tax to arrive at the value of post-tax inheritance. Now, The death state is 950,000. Death year nil rate band of the Lucy herself. Death year nil rate band of the Lucy herself is 325,000. But as the question gives us detail about the Lucy's husband, Pavel also. See, it is a hint that whenever a question gives you detail about the spouse death, whenever the question gives you detail about the spouse death, you always have to think about the issue of transfer of nil rate band. Now, Pavel died in February 17. His chargeable death state, was 160,000. Why 160,000? Because if you read the question, Pavel died, he left 160,000 to Vanda. So what you leave to your children is chargeable. The residue to his wife, Lucy. The residue of the Pavel estate valued at 70,000 included the family home of 720,000. Now there will be issue of residence and RB also, but we'll discuss that. Now we will deduct last 7 years chargeable transfers of Lucy. Is there any last 7-year chargeable transfer of Lucy? So let's read the question. On 1st April 17, Lucy gave Vanda 180,000 in cash. This was only lifetime gift Lucy made. Okay, so gift made on April 17 will lie in last 7 years. Gift made by Lucy to Vanda on 1st April 17 will lie in last 7 years of death in November 2022. So obviously it will lie in last 7 years. So it will get chargeable. Now what will be the chargeable amount if you look at it? Value of transfer of that gift was 180,000 in cash. Now since it was a lifetime gift, so you have to deduct the annual exemptions also. Annual exemption, current year, 3,000, and annual exemption last year, 3,000. Since it is our only gift, so the last year exemption must also be available. Okay. I will repeat the things again. So if anything gets confusing for you people, there is nothing to worry about. Potentially exempt transfer. So this will be 174,000. Since it lies in last 7 years of death, so obviously this will be chargeable. 174,000. Now this gives us the available nil rate band of how much? 490,000 minus 174,000. So this gives us 316,000. Okay. I will repeat the things again because I know that some students might be getting confused. So let's look at it so that you people can have a better understanding that what we are doing. See, the question is that we have to look at the Vanda's post-tax inheritance from Lucy. Now, inheritance received by Vanda from Lucy is of 950,000. This 950,000 is given in the memorandum. We have to deduct the inheritance tax to get the post-tax inheritance. Now, the Vanda's mother, Lucy, died in November 22. Vanda's mother, Lucy, died in November 22. Okay, so we wrote the death state of the Lucy, which is 950,000. Now we deducted the death year nil rate band because the death year nil rate band is important. 0% rate needs to be evaluated. So the nil rate band is 325,000 of the Lucy herself. Now, since there is discussion of the Lucy's husband, Pavel's death, so we need to look at the Pavel's unused NRB. Now, if one of the spouse fails to utilize If one of the spouse fails to utilize complete NRB of death, debt gets transferred. So Pavel died in February 17. His chargeable death state was 160,000 as he gave rest of the death state to his wife, Lucy. Pavel had unused death year NRB because he had no other gifts. Now, Pavel's death year NRB, since no other NRBs are given in the question like the NRB of 2016-17, so we simply pick 325. Only 160,000 is used against the gift he made to Lucy, because he made to Vanda, because Vanda is the child. Rest of the state is given to Lucy. Wife is an exempt party. See, the Pavel must have his death year NRB. He only used 160,000 from it because 160,000 was given to a child. A gift to child is chargeable. Rest of the state was given to wife, which is an exempt party. So this is total death year NRB. Last 7 year chargeable transfers of Lucy. So gift made by Lucy to Vanda on April 17 will lie in last 7 years of death. Okay, so Lucy is calculating the IST. So her only last 7 year gift was in April 17. So value of transfer less the annual exemptions to get the value of potentially exempt transfer. This gives us the value of available nil rate band. Then there is issue of residence NRB also. Because if you read the question, the state consisted of family home valued at 440,000. Okay, so residence NRB is also involved. Residence NRB will be available on Lucy's death state as it includes main residence, which is being given to direct descendant Vanda, who is daughter of Lucy. Okay, so you are giving it to your direct descendants, so residence NRB will be available. Now, if you look at the tax rate sheet, the residence NRB is 175,000. So 175,000 of residence NRB will also be available. Now, there is one more issue. Residence NRB of Pavel will also be available. Why? Because the residue of the Pavel state, which he gave to his wife, was valued at 720,000 and included the family home. Okay. Now, residence NRB of Pavel will also be available. Why it will also be available? Pavel's residence NRB will also be available to Lucy as Pavel gave main residence to his wife, Lucy. Okay, so when you give your main residence to your wife, the residence NRB also gets transferred. So the total NRB now is 316 plus 175 plus 175. So the total nil rate band is 666,000. Just have patience. I will repeat each and everything again. You just need to listen to me carefully. Now, what will be the inheritance tax? On 666,000, it will be 0%. So it will be 0. And the total death state is 950,000. Okay. I will repeat the things again. So don't worry. 950,000 minus 666,000 into 40%, which is the death tax, minus 950 into 40%. So it's 113,600. 113,600. So this is the total. 113,600 is the inheritance tax. We will put it here. 113,600. So the post-tax inheritance will be 950,000 minus 113,600. So it's 836,400. So let's repeat it again, because I know that some students might be very much frustrated because they may not have understood it very clearly. But you know that when you study with me, it's nothing to worry. Just listen while I repeat the things again. So we started with the first requirement because that was an isolated one. When Vendas post-tax inheritance from Lucy, it was a simple 6 marks isolated requirement. Okay, and there were 4 marks of professional. So we made the meeting notes also, client name, date, tax manager, subject, etc. Now we have to calculate the Vanda's post-tax inheritance from Lucy. Now Lucy is the mother of Vanda. Lucy is the mother. She's dying and she's giving inheritance to Vanda worth 950,000 that is given in the manager's memorandum. We need to calculate the inheritance tax to arrive at the post-tax inheritance which is asked. Now, how to work out the post-tax inheritance? We wrote the death state, that's 950,000. Okay. Then there is death year nil rate band. Since the Lucy died in November 22, so the fiscal year of death will be 22-23. Okay. The Lucy's own death year nil rate band. Okay. Lucy's death year nil rate band is 325,000. Okay, your own nil rate band. Now, since the question gives detail about the death of spouse also. Now, Lucy's husband is Pavel. Lucy's husband is Pavel. Since the question gives us detail about the spouse death also. Now, you need to remember that whenever the question gives you detail about the spouse death, it is simply hint of transfer of nil rate band. Whenever the question gives you detail about the spouse death, why he's telling us about Pavel? Why? The only objective of telling that is to make you think about the transfer of nil rate bank chapter. So Pavel died in February 17. His chargeable death state was 160, as he gave rest of the death state to his wife, Lucy, which is exempt party. Okay. Pavel had unused nil rate band because he had no other gifts. Pavel's death year NRB is 325,000. NRB used is 160, so unused NRB is 165. His chargeable death state was 160,000, which represents gift to child Vanda. Okay, he gave rest of the death state to his wife Lucy, which is an exempt transfer. Okay, so I made it more elaborative for you people. Okay, Pavel died in February 17. His chargeable death state was 160,000, which represents gift to child Vanda. The child is a chargeable party. He gave rest of the death state to his wife Lucy, which is an exempt transfer. Pavel had unused death NRB because he had no other gifts, so this NRB goes to Lucy. Okay, now last 7-year chargeable transfers made by Lucy. So that represents the gift made in April 17. It lies in last 7 years. Value of transfer was 180. We deducted the exemptions and we got the value of PAT, which will become chargeable because it lies in 7 years of death. So that is available NRB. Then we'll put the residence NRBs. Then we'll put the residence NRBs. The residence NRB will be available on Lucy's death as it includes main residence. Okay, which is being given to the direct descendants. Okay, direct descendant means your child. Now, Pavel's residence NRB will also be available because Pavel gave main residence to his wife. So if the spouse gives main residence to other spouse, the residence NRB also gets transferred. You have studied it. So that gives us the total nil rate band, 0% on that, and on remaining we applied 40%. And that gives us the IHT and the post-tax inheritance. I hope that it is clear. So this question part was a very good illustration of transfer of NRB and residence NRB and all this mix. Some students may get messed up while doing this. Okay, so I hope that you have understood that how we have worked out the transfer of NRB and the residence NRB issues. Still, if you have any question, you can ask me on my number. Okay, so we have to calculate the post-tax inheritance. We picked up the value of inheritance. We picked up the normal NRB. Since the question contained detail about the spouse death, so we thought about the transfer of NRB issue. Okay, we thought about the transfer of NRB issue, that if there is any transfer of nil rate band involved in the question. Okay, then last 7-year chargeable transfer, we looked at the potentially exempt transfer, the PAT values. Okay, and then the residence NRB, because the death state included the main residence. The death state included the main residence. So yes, the residence NRB also needs to be thought about. Now, since Pavel, the husband, gave the main residence to wife Lucy, so the residence NRB will also be transferred. I hope that this is clear. Okay, now let's move forward. Now, the remaining are obviously about that some business thing, the KS business, which we haven't read. So we'll just copy paste the requirement here before we'll start it. 4 marks requirement, so I think it will be easy one. Value added tax, voluntary registration for value added tax. So let's see. First, we will read about this KS business, and let's read that what is involved in it. Vendor intends to begin trading on 1st April 2023. This business will be operated either by vendor and Roth in partnership or by a limited company owned 70% by vendor and 30% by Roth. Okay? The turnover of the business for the year ending 31st March 2024 is expected to be £48,000. Budgeted profitability of KS. In its first year of trading, the business will either make a small profit or possibly a loss of no more than £20,000. However, once the business is fully operational, it is budgeted to make tax-adjusted trading profit of £100,000 per year. This figure is before deducting any salaries paid to vendor and Roth. The manner in which the profits will be extracted from the business depends on whether the business is operated as a partnership or as a limited company. The 2 alternatives are summarized below. Partnership, vendor will get a salary of 14,000, Roth will not get any salary. The profit sharing ratio will be 60-40. There will be no dividend in case of partnership, obviously. If operated as a company, vendor will take a salary of 42,000, Roth will take a salary of 32,000. Now they will be getting the dividends because they are forming the company. We are just reading the data. We'll come back to it once we read the requirements and we'll look at it in detail. In addition to advising her on the tax cost of the alternative business structures, vendor has asked us to advise her on the relief available in respect of the possible trading loss in the first year of trading, and on the choice of 31st March accounting date where the business is operated as partnership. And then there is some detail about income tax refund. We'll come back to it. So in relation to KS business, we have some information. Let's look at it. The first thing is voluntary registration for value added tax. The sale of children's cloth is a zero-rated supply for the purpose of VAT. With this in mind, explain why the business would be permitted to register for VAT from 1st April 2023 and the advantages and disadvantages of doing so. So I think this is an easy one. It's just 4 marks. We have to comment that why the business will be allowed to register for the VAT And what are the benefits and problems of this? So the business will be allowed to register because it is making a taxable supply. Children's cloth are zero rated, and zero rated supplies are taxable supplies. Okay. The expected sales of the business, if you look at it, uh, it's 48,000. The turnover of the business is 48,000. And if you look at the tax rate sheet, in the value added tax head, the registration limit is 85,000. The registration limit is 85,000 pounds. So the first question is asking that why the business would be permitted to register for VAT. KS business will be permitted to be registered for VAT voluntarily, as it is dealing in children clothes, which is a zero rated supply. Okay. Zero rated supplies are taxable supplies, are regarded as taxable supplies, and any business dealing in taxable supplies can get itself registered for VAT voluntarily. Okay. Compulsory registration is not applicable on KS business, as its current taxable supplies are 48,000 pounds, which is its turnover. Now, since its entire activity is selling children clothes, since its entire activity is selling the children clothes, this new business KS will be dealing in children clothes. You can read it, selling the children clothes, and its turnover will be 48,000 pounds. Its turnover will be 48,000 pounds. Now you can read it. He has made it clear that children clothes are zero rated supplies. Compulsory registration is not applicable on KS business, as its current taxable supplies are 48,000 pounds, which is below compulsory registration limit of 85,000 pounds that is given as its current expected, because he hasn't started the business yet. Okay, but they can get registered voluntarily. Why they can get registered voluntarily? Because they are dealing in taxable supplies. Now, so the first question here was why the business would be permitted. The business would be permitted to register for VAT because it is dealing in taxable supplies. What will be the advantage and disadvantage of doing so? Since you are dealing in zero rated supply, you can recover the VAT. Advantage of getting registered for VAT is that KS business will be able to recover its VAT as it is dealing in zero rated supplies. Okay, this will make its goods cheaper for customers, as it do not have to charge VAT on sales. There is no VAT on sales of zero rated supplies. And what can be the disadvantage? If you write one problem, potential disadvantage can be administrative burden. Now, this is a very routine disadvantage of getting yourself registered. Potential disadvantage can be administrative burden due to VAT registration, as if proper records are not maintained, this can lead to penalties. Okay, so this was a very, very easy one. Even the part A was also very easy one, but since there was some complex calculation of nil rate bands being transferred, so some students might get confused. But this part B was really a very straightforward one, a very easy one. The first thing he asked that why they will be permitted to register. So yes, they will be permitted to register because they are dealing in taxable supplies. What's the problem in it? If I'm dealing in taxable supplies, I'll be permitted to register for that. Okay. The compulsory registration will not be applicable on them. The advantage is that since we deal in zero rated supplies, so it's very good for us to get registered. We can recover the VAT. The potential problem can be the administrative burden. So the business would be permitted and the advantages and disadvantages. So I think that part B was very easy, 4 marks. Now let's move to some problem ones, the 11 marks requirement. Obviously, this will be one big one. Let's see what he's asking. Choice of business structure, income tax and corporation tax payable, which is the part 1, C1. Choice of business structure. Okay. In choice of business structure, he has asked us about income tax and corporation tax payable. Now let's look at it, that what he is asking in this, because I believe that this one will be a bit complex because obviously this requirement is of 11 marks. So let's read it, what he's asking here, and then we'll solve it. Now, choice of business structure, income tax and corporation tax payable. Let's look at it. For a single tax year, calculate the income tax payable by ROT and any corporation tax payable if the business is operated as a partnership and if the business is operated as a company. Prepare a summary of the tax payable if vendor's tax liabilities are business operated as partnership and business operated as company. So basically what we have to do is we have to calculate the tax payable by ROT in the corporation tax payable. Now for vendor, he has given us the tax. So what we have to do is that we have to make a summary that what is the total tax situation if we go for partnership and what is the total tax situation if we go for company. You should assume that the business is fully operational and makes tax-adjusted trading profit of £100,000. The figure is before deducting any salaries paid to vendor and ROT. Profits are extracted from the business in accordance with the summary in my memorandum. ROT continues to earn his existing gross salary of $95,000 per year. When carrying out the work, you should ignore any national insurance liabilities and any reliefs available in respect of the losses. So this is the part B1. I don't think that it will be very much difficult, but let's see that how it will appear. So let's make the summary table first, that what the things will look like. If operated as partnership, and the second column is if operated as a company. Income tax payable by vendor. Now this is given in the question. Income tax payable by vendor. This was given here. Please prepare a summary of the total tax payable if vendor's income tax liabilities are business operated as a partnership 13,672. 13,672. This is vendor's income tax. And if operated as a company, the vendor's income tax is 8219. 8219. 19. Okay. Now, we have to calculate the income tax payable by ROT for both of the situations. Then we will look at corporation tax payable by KS business. Now, obviously, in this case, it will be 0 because in case of partnership, there will be no corporation tax. But in case of company, there will be corporation tax. Total income tax and corporation tax payable. Okay. I will repeat the things again. I want you all to listen to me very carefully. Okay, so he has asked us to prepare a summary. He has asked us to prepare a summary of income tax and corporation tax payable in alternative business structures. Okay, so he's asked us to prepare a summary of income tax and corporation tax payable in alternative business structures. Now, income tax payable by vendor is given in the question. Income tax payable by vendor is given in the question of both the options. Income tax payable by ROT, we have to calculate it. Corporation tax payable by KS business, we have to calculate it. Okay, so let's first start with income tax payable by ROT, or we'll give an heading if operated as a partnership. Then what will happen? In this case, ROT will have to pay income tax on his share of profit. There will be no corporation tax in this case. Now, what will be the ROT's share of profit? Let's look at it. Okay. Partnerships trading profit before vendor and ROT salaries and share. That is given in the question, if you people remember. Give me a minute. This is the column for ROT share. Okay, now partnerships trading profit before vendor and ROT salaries and share. So what is the partnerships trading profit? Now the partnerships trading profit is 100,000. The business is fully operational and makes a trading profit of 100,000. Okay, so this figure is before deducting vendor amounts paid to vendor and ROT. So I'll write £100,000 here. Now, ROT's salary. What is the ROT's salary? If you can look at and here, what is the ROT salary which you'll be getting from the partnership? The ROT salary is 0 in case of partnership. Please listen to me. Believe me, it's very easy. Just concentrate and you will be able to understand. Now, the ROT salary is 0. Vendor's salary is 14,000. In case of partnership, the split is 60-40. Okay? Now, so ROT's salary is £0. So here goes 0. Now, vendor's salary is, now you must be thinking that why I'm calculating the vendor's salary also, because we need to arrive at the residual profit before making the split. Now, vendor's salary is £14,000. £14,000. So here the residual profit is 100,000 minus 14,000 pounds, so it will be 86,000 pounds. Now, what will be the ROT's share in it? If you look at it here carefully, the ROT's share is 40%. Okay, so ROT's share is 40% of this 86,000 pounds. So this will give us how much? 86,000 into 40%. So it's 34,400. Okay. So total ROT's share in partnership is 34,400. Obviously, in the partnership, we need to calculate. That what will be the partner's share before working for the partner. Okay. Now, what we are doing is that we are making a summary of income tax and corporation tax payable in the alternative business structures. Now, if operated as a partnership, the Vanda's income tax is 13,672. It is given in the question. Now, we have to calculate the income tax payable by ROT. Now, the ROT will be getting the share from the partnership of 34,400. Now, we'll calculate the income tax and we'll get the income tax payable by ROT value. And then similarly, we'll move towards if operated as a company. So let's look at it, how we'll work. Now, once we have got the totals, ROT share in partnership, let's move towards the income tax of ROT. Income tax of ROT in this situation will be, now what will be the income tax? So let's look at it. Now, non-saving income. Now, if you remember, ROT's existing salary, ROT is also getting some existing salary, which is also written here in the extract from the email from your manager. ROT continues to earn the existing gross salary of 95,000 pounds. So here comes 95,000 pounds. Okay. Share in partnership profit, which we call as trading income. It's 34,400. So the total income will be 95,000 plus 34,400. It will be 95,000 plus 34,400. So it will be 129,400. Now we will deduct the personal allowance. Now, since the income exceeds 100,000, so the personal allowance will be diminished. Now here you need to learn some shortcuts which can save your time in the examination. Now your personal allowance is of 12,570. You people should remember that the personal allowance is 12,570. Now, if I multiply my personal allowance by 2, because for every excess of 2, allowance diminishes by 1. Now see what I'm writing. Maybe you people can understand this shortcut. Personal allowance will diminish to 0 as income exceeds 125,140. Now, what is the logic behind this? The question is that what is the logic behind this 125,140? When the income exceeds 100,000, the allowance starts to diminish by £1 for every £2 excess. Now, there is no qualifying donation or pension contribution here. Okay, please use your mind. There is no qualifying donation or pension contribution. Above 100,000, the allowance diminishes by £1 for every £2 excess. Now, your allowance is 12,570. Just pick your calculator. Okay, let me calculate it with you in front of you people. Okay, 12,570 is the personal allowance. For every 2, the allowance diminishes by 1. So this means that at excess of 25,140, the allowance will fall to zero. Now your income limit is 100,000, so I'll add 100,000. So 125,140 is a benchmark. 125,140 is a benchmark where allowance diminishes to zero. I'll repeat it again. When the income exceeds 100,000, the allowance starts to diminish. Now your allowance is 12570. Multiply it by 2 because for every 2 allowance diminishes by 1. So 25,140 is the ideal excess after which the allowance is 0. Okay, the income limit is 100,000. So if your income is 125,140, here it's 129,400. So your allowance must have been diminished to 0. So this gives me the taxable income of 129,400, which is the same. Now I will calculate the income tax, some easy things, 37,700, 20%. It will be 7540. Then 129,400 minus 37,700. I'll apply 40% on it because the remainder goes in the higher rate band. 129,400 minus 37,700 into 40%. So it's 36,680. So total income tax will be 7540. I'll add in it. So it's 44,220. I think it's some easy thing. Let me give you a repetition so that if someone has any query, it gets cleared. First, I'll put the income tax here, 44,220. The corporation tax is 0 in this case. So if I add the vendor's income tax also, so the total income tax in this case is 57,892. Believe me, it's pretty much simple. So if operated as a partnership, in this case, Roth will have to pay income tax on his share of profit. The partnerships don't pay any corporation tax. Now, since it's a partnership, we need to calculate the share of profit. So how we'll calculate the Roth share? The profit of the partnership before Vanda and Roth salaries and share. It's written here. You should assume that the business is fully operational and makes a profit of 100,000. So 100,000 is the amount before their shares. Roth salary is 0. It's written here. You can check it. Roth salary is 0 in case of partnership. In case of company, you'll get a salary. Venda's salary is 14,000. We'll deduct that 14,000 to get the residual profit. On residual profit, Roth will get his share of 40%, which is 34,400, and this is the total Roth share. Now we calculated the income tax of Roth in this situation will be his existing salary, share in profit, total income. The allowance is diminished to 0 as income exceeds 125,140. I discussed the logic behind it, that it's the double amount of personal allowance, and then we calculated the tax on it. So I think it was pretty much simple. Now let's work out a situation if the things are operated as a company. Then what will happen? In this case, corporation tax will also be applicable, and in this case, the corporation tax will also be applicable, and income tax will also be payable by Roth. So, now what will be the corporation tax? What will be the corporation tax? Now, trading profit before Roth and Vanda salaries. So the trading profit before Roth and Vanda salaries is 100,000. Okay, the Roth salary. Now, what is the Roth salary in this case? Rot will get a salary of 32,000 and vendor will get a salary of 42,000. Now we are in situation of company. 32,000 and vendor salary will be 42,000. Now always remember that salary is an allowed expense. Salary paid is an allowed expense. Dividends paid are not an allowed expense. Okay. So this gives us taxable, or I would say trading profit, the revised trading profit, 100,000 minus 32 minus 42. So the trading profit is, since there is no other expenses given, dividend is not an allowed expense, the trading profit is 26,000. Now on this 26,000, corporation tax will be payable at rate of 19%. So 26,000 into, now he has told us to ignore the NIC. We are just looking at the income tax impacts. Okay, you can look at it here. He has told us here that when carrying out the workings, you should ignore the national insurance contributions. Okay, because otherwise the NIC would also be allowed expense. So it's 4940. Let me give a revision so that if someone has any query, it gets cleared. Okay. Just a minute. See, the trading profit before vendor and Rot salary. The trading profit before vendor and Rot salary, it was 100,000. It was given in the question. Now this time Rot and vendor salaries will be an allowed expense. What you need to understand is that in partnership, just listen to me. In partnership, the partners' salaries are their share of profit. But in company, it's a separate entity. So your salary is an allowed expense. Now this is the trading profit and this is the corporation tax 4940. So I'll just put the corporation tax here, 4940. And now we need to work out the income tax payable by Rot. Income tax payable by Rot will be, just listen to me with patience and believe me, you will be able to understand. Incomes, non-saving. At this time, there will be dividend also and one last column for Cummings. Existing salary. Now, what is the existing salary of Rot? You should remember that Rot will continue to earn gross salary of 95,000 per year. Okay, he will continue to earn existing salary of 95,000 per year. Okay, new salary from company. Now, what will be the new salary or the additional salary he will be getting? Now, in this case, the Rot will be getting a new salary, an additional salary of 32,000 and a dividend of 6,000. So 32 plus 6. So this salary goes in column of non-saving, dividend from company. This will be 6,000. This gives us the total income, 95 plus 32. So it's 127,000. And this is 6,000. I believe that things are easy, but I will repeat them again. So if you have any query, just listen to me carefully so that if anything comes up, it gets cleared. Okay. Now, what about the personal allowance? Now, obviously, again, the personal allowance will be diminished to 0. Personal allowance will be diminished to 0 as income of 127,000 plus 6,000, which is 133,000, exceeds how much? Do you remember? 12,570 is your personal allowance. Multiply it by 2, because for every 2 excess, the allowance diminishes by 1. So if there is excess of 25,040, the allowance will diminish. Now your benchmark limit is 100,000. So as income exceeds 125,140, personal allowance will be diminished to 0 as income exceeds 125,140. So this gives us the taxable income. Here it's 127,000 and here it is 6,000. Now let's calculate the income tax. Non-saving income. Okay. 37,700. It's 20%. Just listen to me so that things get clear. I'll repeat the things again. So if someone has any query, it will get cleared in repetition. Now the remaining non-saving income is 127,000 minus 37,700. On the remainder, it will be 40%. So 127,000 minus 37,700. On the remainder, it's 40%. So it's 35,270. Now the dividend income on the first 2,000, it's 0%. So it's 0. On the remaining dividend, we will apply 32.5% since we are a higher rate taxpayer. Our basic rate band is used till here. So it's 1,300. Total income tax will be 7,540, 3,5,270, and 1,300. So it's 44,110. I will repeat the things again. Just listen to me with patience, and if there is any query, please wait. So 44,110 is the total income tax. I'll write it here. 44,110. So the total tax in this situation will be 8,219, 44,110, and 4,940. So it's 57,269. Let's repeat it again. Let's repeat it again. Let's go through it again. Okay. If you look at the entire question, this question is not technical. It's lengthy. There's a lot of calculation. But believe me, this whole calculation is very basic. Like calculating income tax, corporation tax, this is not the difficult things. For a student at advanced tax level, this is just like a peanut thing. It's not difficult. We made the meeting notes. Then there was post-tax inheritance from Lucy, where there were transfer of nil rate band issues and residence NRB. Then we moved to voluntary registration for VAT. And then comes the choice of business structure, income tax and corporation tax. Now the income tax payable by vendor, this was given in the question. Income tax by ROT and corporation tax we had to calculate. Now in case of partnership, we calculated the ROT's share. Because in partnership, whatever the partner gets, it is included in his share. His salary, his share of profit, everything is included in his share. Everything becomes part of trading income. So this 34,400 with ROT's existing salary of 95,000 gave us total income. The personal allowance was diminished to 0 and we calculated the tax. Then if operated as a company, then there is a separate entity. The salaries become allowed expense. Now there is no share of profit because now it's a separate entity. We calculated the corporation tax and we worked out the income tax for ROT where his existing salaries were included, his dividend was included, taxable income, and then some basic tax calculation, basic rate band, then the remaining on the higher rate band, dividends 0% band, and remaining on the 32.5%. So believe me, it's not difficult. It's a lot of clerical work involved. Lot of clerical work involved. Okay. So you just need to keep going. Okay. Now, obviously, in exam situation, you will not be able to do it perfect, but obviously it will be an easy score because there was a lot to earn in this question. There were chances of error also in the calculation, but there was a lot to earn, like share of profit, then income tax, then corporation tax, then again income taxes. It was not difficult in my opinion. Okay. Now, if you look at the next part, now this was the 11 marks part. Now, 1 marks is other matters, which is a 5 marks, and the last one is income tax refund. So let's bring other matters here. Okay. It is also part C2, choice of business structure, and now we are looking at the other matters. Okay. So let's look at it, that what he's saying here. Okay. Okay, so we were moving towards other matters. Let's read them. Compare the tax relief available to vendor and rot in respect of trading loss in the first year of trading, depending on whether the business is operated as a partnership or as a company. Now, you all know that if the business operates as a partnership, the loss becomes the partner's individual loss because the partners will get a share of loss. But if the business is operated as a company, then the loss will be the company's loss, and then company will have to relieve it. Okay, I will repeat it again. If the structure is operated as a partnership, the partners will get a share of loss and they will relieve that as an individual loss. But if we operate as a company, it will be a corporation loss and then company will relieve it. So let's see where is some detail given about the loss. In the first year of the business, first year of trading, the business will either make a small profit or possibly a loss of no more than 20,000. However, once the business is fully operational, it is budgeted to make profit of 100,000 per year. Okay, so apparently this is the only information given about the loss. If we go further, we can find out here that vendor has not been employed since 31st December 16 and has not received any income. Roth is employed and earns a gross salary of 95,000 per year. So let's comment on the other matters. Let's look at it. Choice of business structure, other matters. If the business is operated as a partnership, then loss will be given, then loss will be splitted between partners according to their profit sharing ratios, and then partners will relieve it as an individual loss. Okay, so if the partnership business is operated as partnership, then loss will be splitted between partners according to their profit sharing ratios after adjusting their salaries. Now their salaries will also increase the loss. Okay, because what you will do is that if it is written that the partnership will make a loss of no more than 20,000, we will write the partnership loss, then we will hit the partner's salary of 14,000. The loss will increase, and then we will apply the profit sharing ratio to split the residual loss. Okay, so if you want, you can show the calculation, see if he has So there are only 5 marks in other matters. If I look at the email from the manager, compare the tax relief available depending on whether the business is operated as a partnership or as a company. So if you want, you can show the working that how the loss will appear. If the business is operated as a partnership, then what will happen? Let me add a table here. Partnership loss before partner distributions. So the partnership loss before the partner distributions is, that was given in the question, that it's 20,000. Okay, you can see here it's written that the partnership will make a loss of no more than 20,000. Now, Vanda will get a salary of 14,000 and then there is a split of 60-40. So what will happen is partners salary Vanda, which is 14,000. Now, since it's a loss, I will show it negative. Now, partner's salary will also appear negative. And here I will add one row, insert row before. I will put an heading of Vanda, and here I'll put an heading of Rot. So here Vanda will get 14,000 positive, and partner's salary Rot, that is 0. Okay. There is no salary of Rot. Okay. Now this gives us the residual loss. So the residual loss is 34,000. Now this residual loss will be distribution in sharing ratio. So the sharing ratio is 60% and 40%. So 60% of 34,000 will go 34,000 into 60%. So it's 20,400 will go in Vanda's column, and 34,000 into 40%, which is the Rod's share, 13,600 will go here. So the total will be, I think it will be negative 6,400. And here it will be negative 13,600. Okay, so I'll repeat it again. So if someone has any concern, it will get clear. I have shown that how the distribution will be made between the partners. Okay. Now, so because if you look here, the partnership will make a loss of no more than 20,000. Okay, the partner's salary of 14,000 will be adjusted, then we'll get a residual loss. And that residual loss will be adjusted in ratio of 60 and 40. Okay, now each partner will relieve this loss as opening year trading loss, because it is loss of first year of trade. It can be relieved in first. It can be carried back against last 3 years total income on first in, first out basis. I hope you all remember that opening year loss can be carried back up till 3 years on first in, first out basis. And this is the loss of first year of trade. Opening year loss include losses of first 4 years of trading. Okay, now Vanda has no income in previous 3 years because she has not been working since December 17. You can read it here. Vanda has not been employed since December 16 and has not received any income. Okay. Venda has no income in previous 3 years as she had not been earning since 2016. Okay. She will relieve her her share of trading loss against her future against her future income of the business, against her future trading income from the business. Okay. So since Venda do not have any income in the previous years, so she will relieve this thing against her future incomes. And when we talk about Rod can relieve his loss against his total income of previous 3 years as he earns how much? If you remember, he earns 95,000 every year. Roth is employed and earns a gross salary of 95,000 per year. Okay, as he earns 95,000 pounds per year, he can relieve his loss of 13,600 at higher rate of tax and can get benefit of, if I'll just calculate it, 13,600 into 40%, it's 5,440. 600 into 40%, so it's 5,440. So I will repeat it again. Listen to me very carefully. So if the business is operated as a partnership, now the partnership itself do not have any taxation in UK. The tax department says that the partnership profits and losses are split between the partners and they are taxed at their shares. If the business is operated as a partnership, then the loss will be split between the partners according to their profit sharing ratio after adjusting their salaries, and the partners will relieve it as an individual loss. Now we show the working that Venda will first get a salary. Now partner's salary is also part of his share of profit or loss. First she'll get 14,000 as a salary, and then residual will be split between 60-40 ratio. Now Venda will get 6,400 and Roth will get 13,600. Each partner will relieve this loss as opening year loss because it is loss of first year of trade. It can be carried back against last 3 years total income on first in, first out basis. Now Venda has no income in the previous 3 years, so she'll only carry forward the loss against her future incomes. Roth can relieve this loss against his total income in previous years. I hope it's clear. Now, in contrast, if business is operated as a company, then loss will be regarded as a corporation loss, and it can only be relieved against total income of company in future at tax rate of 19%. Okay, because in case of company, you can only relieve it at tax rate of 19%. Okay, at tax rate of 19%. If the business is operated as a company, the loss will be regarded as a corporation loss, and it can only be relieved against the total income of company in future at tax rate of 19%. So in case of company, if it's a loss of 20,000, you can only carry forward it against your future total incomes. You can adjust it against the company's income and relieve it at the rate of 19%. That's all. If you want, you can show the working also, because here it's not written that whether this loss is before adjusting the partner's amount or not, because if I adjust the partner's salary, this loss amount will obviously increase, and in case of companies, we can adjust it at tax rate of 19%. So this was a requirement of 5 marks only, and we have to comment on the advantages of accounting date of 30th June as opposed to 31st March. But The first primary thing he asked was to compare the relief available to vendor and lot in respect of loss arising in first year of trade, depending on whether the business is operated as partnership or company. So if the business is operated as a partnership, it will become an individual loss. And individuals can treat it as an opening year trading loss. Whereas if it is operated as a company, then it's a corporation loss and it can only be relieved against the future income of the company. Okay. Now he asked us two advantages of 30th June year end as compared to 31st March year end. Now this is pretty much simple if you listen to me carefully, because he's saying that on the assumption that the business is always profitable and is operated as a partnership, explain two advantages of having an accounting date of 30th June as opposed to 31st March. So if you go for year-end date of 30th June, you all know that you can get overlappings. In case of 31st March year end, there will be no overlapping. If we go for a year end of 30th June, we can go overlappings. And in the first year of trade, normally the profits are low. You can refer this from the summary notes. You have already studied that in the year end of 31st March, we don't get any overlapping profits. Basis period calculations, opening year calculations, planning of the first year end date. If we go for 31st March year end, there will be no overlapping because we'll be aligned with the tax department. 30th June year end, you will get overlappings. Now, overlappings are beneficial due to two reasons. Number one, the first year profit is low, so it gets taxed twice. This helps us in delaying the profits of next year's, which are higher profits. And it also helps us in improving our budgeting. Okay, so this is a topic which we have already studied. Let's draft it. So two advantage of 30th June year end as compared to 31st March year end include: number one, in case of 30th June year end, there will be overlapping profits because our accounting year will not be aligned with the tax years. Okay, in first year of trade, normally profits are low. So getting them taxed twice through overlapping profits helps the business delay its tax on high profits of next year's. Okay, so the first thing is that if we go for 30th June year end, we can delay our high profits of next year. Okay, because normally in the first year, the profits are low due to capital allowances on major purchases and due to startup problems. Okay, secondly, in case of 30th June year end, as there is overlapping profits, therefore, old profits are taxed again. This improves cash flow budgeting of company, as it can be known that what tax will be paid in next year. Okay, if you people don't remember, and I'll open the summary notes for you people, you can just look in the trading income. The purpose of showing this is to give you a reminder that we have already studied this. And I'll go to the trading income. Now we have the opening year, and here it's first accounting period date. If capped as 31st March, there will be no overlapping. However, date of accounting date is capped as 30th April, then overlapping will be maximum. If first period profits are low, then overlapping is beneficial as same profits will be taxed again. Okay. It also improves the budgeting. You already have studied this. So 30th June year end, because just think about it. If you go for a 30th June year end, your first assessment will be till 31st March. Then 3 months will be remaining. So you'll go back 12 months. So it will create a second assessment. It will create a reassessment. Okay. So he asked about other matters here. Where he asked us about the loss in the first year of the business. He asked about the loss in the first year of business. So he said that if we operate as a partnership, it will become an opening year loss. If it operate as a company, the loss will only be relieved against future income. Okay. Then two advantages of 30th June year end as compared to 31st March year end. So if we take a quick review of this answer before moving towards the last one, we made the format of the meeting notes. That's something very basic, repetitive. Then there was Venda's post-tax inheritance from Lucy. This includes some complex rules in relation to transfer of NRB and residence NRB. I hope you all remember. Once done with this, we move towards voluntary registration of VAT, which was something very easy. Then he asked us to make a comparison that what will be the taxation if we operate as a partnership and if we operate as a company. When that taxation was given, we had to calculate the tax for ROT. I hope you all remember. And then we did this other matters where we have to comment on the loss and the choice of year-end date. Now, if I'll move towards the last requirement, there is something about income tax refund. Let's look in the requirements tab. It's a 5 marks requirement, and apparently it is relating to ethics. Okay, so let's see what he's asking in income tax refund. Prepare a summary of the actions which we should take and the matters which vendors should be aware in relation to the income tax refund. So let's look at the extract from the manager, what he says about the income tax refund. Vanda has received an unexpected refund of income tax from HMRC in respect of the tax year 1560. So she has got some refund and she don't know that what it's about. So he's asking that what actions we should take and what matters Vanda should be aware. So obviously we should investigate that what is the reason of this refund. If we cannot find the reason of this refund, Vanda should notify the HMRC. Okay. If she'll fail to notify, they'll impose penalty. It will become an issue. And obviously it will be an unidentified income. So it will become issue of money laundering also, that we have got some amount and we don't know the source of it and we are hiding it. Okay. So income tax refund, 5 marks, easy requirement. Vanda should investigate the reason of this income tax refund in relation to 2015-16. If I'm not wrong, should in relation to 2015-16. Okay. She cannot keep the refund without having a known reason for it. Okay. If reason of refund cannot be identified, vendor should return the amount to HMRC. Okay. Otherwise, it will become a legal matter. Okay. HMRC can impose penalties on vendor for keeping an unknown refund without any legitimate reason. Okay. It will also create issue of money laundering if vendor keeps the amount without knowing its reason. Okay. It will be keeping an unidentified source amount and then hiding it from HMRC. Okay, our firm should convince vendor to follow, to investigate the reason of refund or otherwise return the amount to HMRC. If vendor do not agree to do so, then firm should consider resigning from vendor's tax engagement, as this will create issue of integrity then. Okay, this was a simple part of ethics where we have to comment that she has got some unidentified refund. So we commented that she should investigate the reason of it. She should investigate the reason of it, that what this refund is about. Okay, that what this refund is about, she should investigate the reason of this refund. And if that cannot be known, she should return the refund. And if she'll not return, the HMRC can impose a penalty, which can be really a big issue. And our firm should also consider resigning from the engagement if she do not agree for the ethical actions. So if you look at this entire answer, in my opinion, this was not a difficult one. There was some basic format of meeting notes. Then there was some IHT calculation on transfer of NRB, residence NRB issues. I will agree that it's complex, but I would say that it is not difficult. Okay. Then voluntary registration of VAT was something very easy. Then choice of business structure was really very easy. There was some basic income tax calculations, but since it was a lengthy part, some students may have got confused. Then in other matters, there was about the loss. So you have to think about opening year loss because it was first year of trade, and then choice of year end and this income tax refund. So I believe that it's clear. If you have any query, you people can ask me on my WhatsApp. We'll continue further in the next class with question 2, 3, and 4 of this paper. Okay. Thank you, everyone.